Sorry. So welcome back after that short coffee break. We're going to be back on track on the timing, I'm sure. It's time now for the last session of this 25th annual conference of the IAIS. The session called I'm French, I'm sorry. Supervisory, discussion of a holistic approach to insurance supervision, making the link between prudential and conduct of business supervision. To moderate this last session, I'm glad to invite here on stage Chair AEOPA Member Executive Committee, Gabriel Bernardino. Thanks for a warm applause.
So good afternoon, ladies and gentlemen, and thank you very much, Gabriel. You used to deal with one Gabriel, so today you have a double dose of Gabriels. It's even worse. So we were going to have, hopefully, a good session. It's the last session, of course. We hope that you would not regret that you stayed to hear this last session and to deal with this interesting issue of the link between prudential and conduct of business supervision and the challenges around this. We're going to have 5 panelists that I ask to take the stage, please. Can you please move there, and then I will present you all. That's perfect. So from the far left, we have Hema Curtis. Hema, she's the Group Senior Manager of Insurance in the Australian Securities and Investment Commission, ASIC, dealing with the conduct of business supervision in the Australian market. Then close to her, we have Greg Van Elsen. Greg is an advisor of financial consumer protection to the European Consumer Organization, BEUC, and more importantly, is the chair, elected actually recently in September, the chair of EIOPA's insurance and reinsurance stakeholder group. So the person that is leading the advice to EIOPA from our stakeholders. Then close to him, we've got Kasian Koh. He's the CEO of Manulife Singapore. Welcome, of course. Then we've got Catherine Wade, which, as you know, is the Commissioner of Insurance in Connecticut in the US, and also the chair of NAIC International Insurance Relations Committee. And last but not least, we've got Fernando Restoy, which is the chair of the Financial Stability Institute that I would say many of you know, of course, has been contributing a lot also to the capacity and the knowledge of the supervisory community around the globe. So just a kind of a brief introduction to our team today and this kind of holistic view and holistic approach to supervision, touching on prudential and conduct of business. And this was mentioned, I think, both by Vicky and by Jonathan at the beginning. Of course, in the aftermath of the crisis, it was clear that there was a lot of focus from the regulatory and supervisory community on the prudential side. It was, of course, needed to deal with issues related to solvency, capital, all those elements. But in the recent years, more and more attention has been taken and given to conduct of business supervision. And if there's one of the things that I believe that really happened also, that the crisis showed, was that it's extremely important, the sound conduct of business for the long-term sustainability and stability of the financial sector. So this idea that conduct, good governance, good conduct is also fundamental for the sustainability and of the financial system. And at the same time, as we have been discussing, in these 2 days, there's a lot of course, emerging developments, new technologies, or many changes that we have in our world and in our economies that bring definitely new types of risks also to the sector and to the consumers. And so this element of new added, new developments, new technologies that create a lot of new opportunities but also bring risks to consumers, also gives rise to a more focus on conduct of business. The interesting thing, of course, is that our world is quite, I would say, dynamic and diverse, and the way that supervision approaches both prudential and conduct of business is not unique. There's very different types of schemes around the world in terms of the way that supervision is done. And one of the things that we would like to discuss today is this: how can we have this kind of holistic framework on how to look to prudential and conduct of business supervision. One thing is for sure, there's a clear interaction and clear dynamics between these two aspects, because there's abundant evidence that, of course, very often poor management from a prudential perspective with solvency issues very quickly creates elements and problems in relation to unfair practices that will, at the end of the day, bring detriment to consumers. But also on the other side, there is evidence that, of course, if there is poor governance and poor conduct of business, ultimately this will also create stability issues and solvency issues. So there's clearly in here a dynamic that I would say calls for this holistic approach to supervision. So that's basically the basis of what we have today. And I would like to start the discussion with one simple question to each one of you, which is basically, could you name what are for you the 3 biggest risks that you see from a prudential conduct of business perspective in the regions where you do supervise, do business, are consumers, etc. So, Emma, do you want to start?
Thanks, Gabriel. So starting on the conduct side and thinking about consumer harms, the 3 biggest issues that we see today are to do with product design, product distribution, and claims handling in relation to insurance. And a lot of these issues have been actually brought out this year in Australia because we've had a Royal Commission into Financial Services which has uncovered a lot of issues in these areas. So just to delve down a bit deeper into that, so designing products, we've seen that there's been an issue with designing products that have low or no value for consumers, and they haven't been designed with the end consumer in mind. They've really been designed with the profitability for the distributor or the issuer in mind. Then another area where we've seen issues is in the use of pressure sales to sell products. So we've seen sales of products to people who haven't necessarily understood or wanted or needed the product, or it hasn't been suitable for them, so they haven't been able to claim. So that obviously results in conduct risk and the risk of remediation and the risk of penalties for misconduct. And then the third area where we've seen issues is around claims handling and issues where the claims handling process has been very slow, inefficient, onerous for the consumer. Obviously, it's at a point where the consumer is having a difficult time having to make a claim, and that process can be very drawn out and mean that they don't get back into their home for a long time, or they don't get their benefit paid out for a long time. And I think an overlay on those 3 areas is the use of data and risks about how data can impact on all those 3 areas, and making sure that that's not detrimental for the consumer. So that's on the conduct side. And then on the prudential side, so I think one area is sustainability of individual product lines. For instance, in relation to life insurance, income protection is a product that we've seen in Australia has had very high payout rates and perhaps hasn't been priced properly and has sustainability issues, which leads to prudential concerns. And another area which was highlighted in the previous discussion is around climate change and severe weather impacts. Particularly in Australia, we have high flood risk in northern Australia, which makes that part of the region extremely difficult to provide affordable insurance for. And then the last area, which also links back to the Royal Commission and some of the issues that have come out of that, is around governance, remuneration and culture. And we're seeing some potential law reform in that space to introduce accountability for executives and looking at how incentives affect conduct through conflicts of interest, for instance. So a lot of issues in that space as well.
No, very good. A long list. We'll come back to some of these, I'm sure. Greg, main risks.
Well, main risks. Let me first, I think I can echo many of the risks, and even though Australia is so many kilometers away, I think many problems that you described, you also see at the EU markets, namely also regarding data. We also see a lot of issues there. Maybe to highlight one is the cost of privacy. To what extent will consumers be penalized if they are not willing to say when they are driving, or if they're not willing to give to insurers how many steps they are taking every day. So that cost of privacy, that's something we're quite worried about. Then there's the patchy advice framework. We have had a lot of conduct rules over the last years, but it's split into different sectoral, it's split along sectoral lines, and also online distribution is making the current conduct framework for advice, for instance, very tricky. And then the last one is an insurance guarantee scheme, which we don't have at EU level yet. In an environment where more competition might be there, there's also some more prudential risks. We deem it also quite dangerous that we don't have at the EU level a good insurance guarantee scheme. Voilà.
Bob, very good. Ka?
I think I look at it from perspective of maybe Asia, even though I come from Singapore.
Yes.
I think there are the three areas I would say probably high risk is. One is still probably on the prudential areas. So if you look at risk in terms of, if you look at the markets today, it's very volatile. Interest rates volatile, equity market is very volatile. And I think some countries, especially in Asia, still have not move into kind of a risk-based capital regime. So for these countries, I think dealing with challenges in the volatility of market is a problem, because a lot of the Asian countries are still selling a lot of products with guarantees, right? I think with products with guarantees, if you deal with interest rates and if you back it up by equity, certainly those will give challenges to the companies. The second, I would say market conduct. In Asia, a lot of companies are still distributing their products face-to-face, either through agents or through the advisors from the bank. So as a result, I think the standards of the people selling the product to the consumers, the education of the consumers as well as the sellers can vary significantly. And I think standard across different countries are also very different, and development of market conduct standards are still evolving. As a result, I think you see that this can be a challenge area, because if they are not done well, the problem will arise many years down the road when potentially the advisors are no longer with the company, and some of the things they sold have been sold wrongly or missold. Third area, I would say, is data and technology, because I think increasingly, most companies are starting to gather a lot more data from the customers and holding on a lot of these data and exposing them through various devices that they make available to their advisors, or exposing them by creating website and so on and so forth. So for all these things that we kind of discussed whole of today, there's a lot of issues relating to loss of data. There's a lot of issues relating to how these data are being used. So I think these are the three areas that I would say
Very good.
more for
Thanks
insurance.
a lot. We'll come back to that. Katie, please.
So from the three prudential issues, so it's market and liquidity risk. So we've had a historical bull run in the markets, and in the last 2 years, we've seen the Fed increase interest rates about 8 times. So if there were a significant market correction, that could create pressure on the companies. And then from a cyber terrorism perspective, we don't believe there's a model out there that really takes into consideration taking out major power outages, what that would mean to the financial markets, what would that mean to the insurance consumers, businesses, as well as the insurance operations. And then it was mentioned in one of the panels earlier, the long-term care insurance market. So in the US, there's longer claims are increasing for much longer duration than had been anticipated, and that's creating pressure from both a pricing as well as a reserving perspective. And then from a business conduct perspective, natural catastrophes, they're happening more frequently and at a higher level. And so state regulators are working very hard to make sure that people understand the cover that they need, but also working with the companies to make sure that they're doing appropriate claims handling as quickly as they can, but also fostering risk mitigation so that resiliency and recovery can happen more quickly. And then also touching on data, the use of data, how data is being used in new models, and really understanding from a regulatory perspective, as well as consumers. Companies need to explain how they're using the data, how they're gathering it, how it's being used, what are the correlations, so that we can fully understand that it's not being used as a proxy to discriminate. That, of course, is creating an issue for us as regulators to make sure we're changing the skill set of the folks that work, but also building on the cyber issue and making sure that companies are doing the things that they need to do, what's happening, because we've had some significant data breaches, particularly in the health insurance arena.
Yeah, good. Fernando, last word.
Thank you, Gabriel. Of course, we are not a supervisor. We are not even a regional association of supervisors. But I can answer this question based on the exchanges we already have with insurance regulator, particularly in the context of making up, of preparing our program of activities. Of course, we want to address those issues that keep our colleague supervisors awake at night. So for that purpose, we conduct those exchanges with them. I guess, my list is pretty much intersects with a number of challenges that have been posed by other speakers here. Certainly, technology is featuring actually very prominently now. Everything has to do with that, including data. Also, obviously, climate risk issues that have been covered in previous sessions, and some of them may actually be covered in this session later on. But let me add an additional challenge, which I think is gaining increasingly relevance for some supervisory authorities, particularly authorities with complex mandates involving a plurality of objectives. It's not only about prudential or conduct of business, but sometimes it's also about promotion of the industry. It's about promotion of technological progress, financial inclusion. So at the end of the day, we have a large list of objectives, not such a large list of instruments, and this may actually create important challenges for supervisors, how to prioritize objectives when taking specific decisions.
Yep, very good. So, as you can imagine, this was a planned question. Now they're going to be surprised by, because you said so many interesting things that I need to capture a little bit of questions. Maybe, Emma, one of the things that you mentioned, the issue about product design and the low-value products, and I'm really interested. I'm following the Australian experience in this area. This immediately comes into issues related to pricing, commissions, and things like this. How do you approach it in the Australian sector? You're not a pricing supervisor, I imagine. So how do you analyze the market practices and come to any kind of conclusions and recommendations?
Yeah, that's a really good question, because that's correct. We're not a pricing regulator.
Yep.
However, in this particular market, an example is the sale of add-on insurance through car yards. So when a consumer buys a motor vehicle, they will often take out a loan at the same time, and they'll often have some insurance bundled into that transaction. And it's not comprehensive insurance. It's gap insurance, consumer credit insurance, tyre and rim insurance. So when we became aware of the problem, we collected data and we analysed the data, and the data showed quite clearly that there were very low claims ratios, around 10%, 9% for these products, which clearly showed that there was very low value for these consumers in these products, and the bulk of the premiums were being paid in commission to the car dealers. And in fact, car dealers were making more money out of selling insurance than they were out of selling cars. So clearly, the market was not operating to the consumer's advantage, but it was operating to the advantage of the car dealers. And it meant that consumers were buying insurance that in some cases they were not able to actually claim on because they didn't meet the eligibility requirements, or it had a very low value for them. And that was shown in the claims data, which showed very low claims ratios and claims payments. So in that case, we were so concerned about the conduct and the structure of the market that we thought it was important for us to take action. And we were able to actually intervene and negotiate remediation programs with 4 major insurers on a voluntary basis without going to court, and which we thought was a very important outcome because it got remediation back to consumers
Yes.
as quickly as possible. And we were also able to work with the industry to have them reduce commissions, and we also are working to introduce a deferred sales period so that there's a deferral between the time when the car is purchased and the credit arrangement is entered into and the purchase of the insurance of, say, 4 days, which enables the consumer to think about whether they really need that insurance, because we find that there's information overload at the point of sale where they're actually there to buy a car. They're not thinking about the insurance, they're not focusing on that. So there needs to be a separation of the two processes. So that's the process that we adopted in that case.
No, that's definitely a kind of a paradigm shift, and to also have clear expectations from your side outside to the market. Very interesting. One of the things that struck me also was what Kassiang said on the difficulties, of course, and the issues related to distribution, and of course, in Asia, still very face-to-face distribution, and of course the elements which are quite relevant in terms of making sure that you educate your sales forces, etc. Make a little bit of a provocative question. Do you think that those issues will be solved, and if you have basically robo-advisors, or we create other types of issues?
Not a simple question to answer because I think if you look at robo-advisors, the advance of robo-advisory currently more towards the advice on investment, right? And I think there are new development looking into robo-advisories to help customers to find their needs and so on and so forth. I do agree that I think robo-advisory in some way would be able to help to close the gap, right? But unfortunately, if you look at Asia, I think the knowledge of consumer, right, is very, very low, right? Knowledge of consumer is very low. Ability of them to understand the needs for insurance is very low, resulting in a lot of times that insurance kind of the popular notions that insurance is sold and not bought, right? Because nobody would kind of wake up to say, I want to buy insurance. I know this is a common notion, but we need to kind of move forward, right? Technology definitely will help us to have the opportunity to change how consumers feel about insurance. And that can be done in many ways. Of course, robo-advisors is the delivery mechanism, but I think more importantly, in order to reach the stage where people really kind of go and say, I'm interested to look into my insurance, is when insurance company themselves and the propositions they give the consumers is something that can be engaging, something that is easy for them to purchase. And that's where I think all the new technology and new advancement is kind of focusing on, making insurance convenient and easy for people to purchase, but more importantly, creating new ways for people to say, I'm interested in the proposition. So
engage.
More towards that way, but I think it's still a long way to go, because I think even looking at the ability of us using the behavior to kind of predict risks is still a long way to go, and there are issues associated with that as well.
Yeah, that definitely.
Yeah.
Good. Fernando, you mentioned this issue of the different mandates and different objectives for supervisors, and that was an issue also that we touched today. Well, of course, you see around the world, supervisors that have a quite focused prudential financial stability mandate, conduct mandate, but in other parts of the world also, on top of that, the development of the market. There's this kind of fundamental principle from of course, the textbooks that say that, for each of the objectives you should have a tool. How do you see that in reality nowadays? And do you see an inherent conflict in between the more stability prudential mandate and the market development mandate? Only simple questions.
Very simple, yes. I mean, of course, some objectives are relatively complementary, and therefore there will be no conflict there. But frankly speaking, I think, particularly what you see, as you said, in some regions of the world, that some supervisors are sort of taking a sort of a leading role in national strategies aiming at, say, creating insurance hubs, for instance, or at the very least, like, to promote very actively innovation in competition with other jurisdictions, then I think that there is a potential to have relevant conflicts there. I think that supervisors being too much focused on a industrial policy type of objective, normally this from time to time will actually create some frictions with the key function of regulators. That could be something related to market stability or market integrity. So yes, I think there's a potential challenge.
Yeah, sure. That is something that needs to be kept under monitoring, definitely. Very good. So, can we put now in the screen, I hope that you have voted as the first question that we had, which was in a forward-looking approach, where do you think supervisors should focus their attention? And prudential, conduct, both, or none of this. I'm very happy to see that none of this is 0%. So there's future for supervisors, for sure. Prudential risks are definitely taking a little bit, but both, it's overwhelming response, and I think that probably around this table we will all definitely concur to that response. That's very good. Now, if I can turn to the supervisors here at the table, Emma and Katie. As supervisors, it may, of course, sometimes be difficult to balance prudential and conduct of business supervision. How do you see these interlinkages? How do you ensure that there is this, holistic approach that ensures at the end of the day that you cover both areas? And again, the point that is very often mentioned, aren't there intrinsic and inherent conflicts between these two roles? How do you manage them in different, of course, mechanisms? And also, if you have examples of conduct risks that at the end of the day derived also prudential concerns. Can I start with you, Katie, this time?
Sure. So, in the U.S., we're a consolidated regulator. So we have both prudential as well as market, what we call market conduct, the conduct of business. And there are numerous examples that we have where something came up in a business practice, a claim handling, that then we determined through investigation that it was a prudential concern. And those things happen a great deal. And so in most insurance departments, they distinguish between there's a financial regulation division and there's a market conduct division. But the important part of that is the coordination and collaboration between those divisions as well as others, for us to understand what's going on with a company so that we can address the issues and make sure that we are looking at this and that we are looking at it from both angles. And so, I can speak about what we do in Connecticut.
Yeah.
So we have on a regular basis, we have every division, so the financial regulator, the market conduct, the consumer affairs, our life and health division, our property and casualty review rate and forms. We get together and talk as a group about individual companies, what's going on with our individual domestics, as well as issues that we're seeing, and as well as national issues. So that's how we take a holistic approach to it, and we think that addresses the issues about balancing the need.
Yeah, very good. Emma, you're coming from a different framework with the Twin Peaks approach. So how do you handle that, and how do you see it?
Yeah, that's right. So we have a Twin Peaks model where we have ASIC as the conduct regulator and APRA as the prudential regulator. But there is a lot of overlap, so our models are quite different and the stakeholders are quite different who we regulate, but there's a lot of overlap, and insurers are one of those areas. So we both have separate pieces of legislation that we regulate, but within that legislation there is overlap, and insurers often have to be licensed by ASIC and also authorised by APRA. So we're often regulating the same entity.
Yes.
So in doing that, I think it's really important communication and coordination is the key, and as you do within one entity, we have to, I suppose, make more formal steps and arrangements to do that, and to do it quite consciously to make sure that we are coordinating our work. And I think it's really important for the two regulators to understand the two separate roles that they have within the financial system. and to respect that role and the strength of our work together comes from having that complementary approach and sort of respecting the different perspectives of each regulator. But when we work together in that way, it can be really powerful because we can share information, share perspectives, and so we can each help each other's work. And there have been examples in Australia, for instance, there was a couple of years ago, there was a huge claims handling issue that was revealed through the media and through a whistleblower in relation to a particular life insurer, and it looked like a conduct issue, but it obviously had ramifications from a prudential and financial stability perspective. So the two regulators were able to work quite closely together on that, and that was a very efficient and effective way of dealing with the issue. So we each pursued our own lines of inquiry based on our respective regulatory perspectives, but we were able to work together very efficiently.
Yeah. Very good. Just one curiosity, do you do joint on-site visits together with APRA, for example?
We haven't tended to, but I think that we will be doing more of that in future because so the Royal Commission that I mentioned before has put a spotlight on how the two regulators work together, how they complement each other. So there'll be a renewed focus on us doing more joint work like that in future, and I think it makes sense.
Yeah.
I think there's a lot of value for the insurer or the regulated entity to be talking to the two regulators at the same time, so everyone's getting the same message.
Yeah, that was my point exactly. Kasyang, you of course coming from a big international group with a lot of presence also in Asia, and Asia is of course a kind of really high growth market. Do you see any particularities that are coming from Asia in terms of conduct risks compared with other areas? Are there something that we can learn from Asia? One of the things that I really see in the Asian colleagues is that a lot of also innovation and new technologies being used in new business models. So what lessons can we take from Asia in terms of market conduct also?
I think in Asia is actually very diverse, right, as compared to maybe Europe. But if you look at Asia, you have countries who are still starting to get into insurance, countries like Myanmar, country like Cambodia, Vietnam already starting to establish a bit more, but I think still at early stage of development. Then you have country Hong Kong, Singapore are a lot more developed, Japan, and so on and so forth. So I think the market in Asia can be very diverse. And of course, not ruling out that, some of the countries you see technology and some of the new innovation is also starting to come in, which are encouraging because hopefully that will kind of overcome some of the issues that arise from the traditional way where insurance has been introduced to the market. But I think learning from Asia, I think Asia has a lot of things to learn probably within itself. So for countries that are still developing, new countries, I think they can learn a lot from maybe some more developed countries, including within Asia. From their perspective, I think prudential regulations and prudential standards are still very critical. A lot of time, if you look at some of the established market, we are still struggling with some of the issues or legacy issues that came from many, many years back, because the prudential regulation then potentially was not as thorough and resulting in, companies probably have to handle it. So if those areas are taken care of, if you think about it for these emerging countries, hopefully those problems would not arise. Secondly, I think financial robustness of the companies are important, right? Because those things can give rise to really major issues that unfortunately is kind of beyond the conduct kind of scale. But for the more established market like Singapore, for example, I think conduct issue is getting a lot of focus, right? Because generally, if companies, in fact, it's very difficult to sell to customers to say, look, my financial strength is so much stronger than the other, right? You tend to sell because of your reputation, right? So companies tend to focus on how to build the reputation with the customers, and that become kind of critical and competitive advantage, and having a strong regulatory supervisory framework on those areas actually is very beneficial.
Yep.
Yeah.
No, very good. Great. Greg, you have been, of course, observing the evolution of also regulation supervision in the latest years in Europe. How do you see the evolution of overall consumer protection in the insurance sector? And I know that particularly you have been quite a supporter of mechanisms like product oversight and governance. How do you see that as relevant in terms of protecting consumers?
Yes, thanks for that. Indeed, we've seen conduct of business regulation really change over the last years. Although conduct of business is still a little bit, I would say, the side dish of financial regulators on the whole bigger regulatory menu. I think that after the financial crisis, in terms of financial consumer protection, two things happened. We had at the EU level, we had the establishment of the ESAs, and also EIOPA. Also got an explicit mandate for consumer protection. So I think that was very important, but that wasn't initially that was not really planned. So there was a lot of pressure was needed to give EIOPA those consumer protection powers. So that still, I would say, highlights a little bit the worry of some market participants on the importance of conduct of business, because I still tend to believe that conduct of business and prudential rules and prudential objectives can be very conflicting, and we often sense that supervisors still still care about the profitability of banks, of insurers, and having very strong conduct rules could obviously impact that profitability. So that's still a tension, which is not very, which is still there, which will always be there. And I think that's well reflected also if you see what has happened then after the financial crisis. In terms of rulemaking, there has been a lot of rulemaking at the EU level, but really tough rules which really impact the business models of insurers. They are often not really, they are often stalled in the process. So we are still, in terms of conduct rules, they're still the paradigm where we have disclosure, so the transparency, nobody is against it, but then, of course, we all know that there are limits to disclosure, and we now have a key information document. We discussed 10 years about it, and still nobody is really happy. So we need more. We need conduct rules, for instance, to tackle commissions. But also there we see that it's very hard to get like really strong measures which could impact really the business models. But now I'm coming to product governance, which I'm supportive of. But for me, I think that's a little bit the last strand of traditional conduct rules, where still you try to steer insurance companies to better treating their customers while they're still in the driving seat. So with product governance rules, insurer has to establish a target market. They have to stress test also products. They have to look at the distributors. The question is, how will that be enforced? Obviously, and and we have to. I think we have to avoid that this will be just an exercise for compliance officers, but that it's not really changing things a lot. But now, yesterday I was in Paris discussing with securities market participants the product governance rules, and there apparently things are changing a little bit, and there were some worries from stakeholders that there's now less choice to consumers, and I think in some markets that's a good thing. That practitioners are now really are a bit more critical towards, okay, what products are we bringing on the markets? How are we distributing that? So for me, product governance is really the last resort of traditional conduct rules. And if that's not working, then we have to go more to price regulation, to product intervention, which is also coming more and more in vogue. There was a very interesting discussion paper launched by the FCA last month about price regulation. So if 4 or 5 years ago, if you would discuss price regulation, you would be removed from any audience or any panel already. But now it's starting to become also discussed in the light of, there's still many problems out there, but POC is a good thing.
No, it's, you know that we have been discussing this definitely, and as you said, it's the kind of less traditional measure in terms of the bouquet of usual measures, but it needs to be coupled with better supervision and implementation and enforcement. Otherwise, you don't close the circle. So that is something that needs to be ongoing, of course. Good, Fernando. One of the things that you have been looking, of course, from an FSI perspective, was in terms of the kind of lessons from the crisis that we had, of course, and it's, I think, clear for all of us nowadays that the crisis came from some poor prudential management, but also some poor conduct in there. So what are really the lessons that you learn from the crisis in relation to this appropriate coordination between prudential and conduct of business? And how have you seen the models evolved in the last 10 years after crisis to ensure that we cover these lessons?
Yeah. Well, as you said, I think that the crisis revealed a number of quite disruptive episodes of business misconduct. That's clear. At the same time, as you rightly pointed out, Gabriel, I think that you can only explain the huge scope of the crisis by referring to prudential issues. Basically, is that you have that the risks are undertaken by firms were actually underestimated by both the firms themselves and also their regulators. And we had to be very conscious about this. And also we had to basically acknowledge, that's why we got into this incredibly ambitious regulatory reform, is that at that time, actual regulation was not sufficiently strong to make sure that firms were in a position actually to absorb losses generated by the materialization of those risks. And this basically what explains actually what happened. It's also true, though, that from a more institutional point of view, I think in the crisis we also identified several episodes in which there were some coordination failures in the management of financial crisis. And in particular, there were some coordination problems between regulators, between sectoral regulators, and more frequently between regulators and central banks when the central banks were not actually supervisors. This is something that happened. So against that background, this should not come as a surprise that indeed, as you said, several jurisdictions undertook a process of reform of their supervisory model, supervisory architecture. And we conducted this analysis at the Financial Stability Institute that we published before the summer, in which we analyzed precisely the evolution of supervisory models since the beginning of the crisis. Okay, so we identified, most jurisdictions undertook some sort of modification of the supervisory model, but could identify some sort of general features. Let me just summarize three of them. First is that certainly the powers in relation to consumer protection were really strengthened. So consumer protection regulation was modified, was enhanced, was improved in many jurisdictions. Second, it's clear the central banks actually gained supervisory responsibilities, particularly for banks, but also for insurance companies in several instances. And the third element is that, however, it's true that insurance companies remain supervised in most jurisdictions by sort of specific agencies, sectoral agencies, that will have responsibilities for both solvency and consumer protection, conduct of business. So you will put together those three features. I think it's clear that the modifications go in the direction of trying to exploit as much as possible synergies across different policy functions, and paid somewhat less attention to potential conflicts of objectives. For instance, those that could arise between, trying to protect or trying to oversee the safety and soundness of financial institutions and their conduct of business. Well, those potential conflicts of objectives sort of were not the main trigger of the modifications that we have observed. For the case of insurance companies, that is an interesting topic to discuss. A good rationale for that could be that maybe the complementarities between consumer protection and solvency are as important as, if not more important, in the case of banks. But possibly the potential conflicts of objectives is probably less relevant in the case of insurance companies. For instance, because you could consider that insurance companies actually, or the failure of insurance companies is less likely to create a systemic impact. Because of course the contagion risk probably is smaller, and also because, I mean, it is very rare to observe sort of policyholder run, as we could observe actually the deposit run for banks under critical situation. So if that is the case, actually, well, supervisors may have less incentives to overlook possible infringements of conduct of business rules for insurance companies and for banks, even if insurance companies could be under financial stress. So that could be a possible justification why, in principle, you will observe less conflicts between, protecting consumers and also overseeing the safety and soundness of insurance companies as compared to the ones you see in the case of banks. And indeed, it's clear that if you look at your ICPs, it's very clear stress is linked between consumer protection and safety and soundness. Basically, you say that the main role of insurance supervisors should actually be to protect safety and soundness for the benefit of policyholders. So this does not happen actually in the case of banking. We will have actually the core principle, the Basel core principle for banking supervision. The objective of supervisors, the main objective of supervisors, should be to protect, to protect the safety and soundness of banks, of financial institutions, full stop.
Yeah, no, but that is clear, and I think that there's a really long tradition in the insurance side of having this much bigger interrelationship between the solvency and the protection of the consumers at the end of the day as a fundamental element. And I think also an element that we see is that probably there's no bulletproof. There's no model that have proved that is the best one in all situations. We have seen all the different types of models failing in different conditions throughout the years.
And this has basically remains after the crisis in most jurisdictions. So basically this combination of consumer protection objective with solvency objective, except in countries that have moved in the direction of the twin peaks. So in that case, basically the reason is because they saw probably more important synergies, which are the ones between sort of central, I mean, it's not the case of Australia, so it's a sort of an exception. For the rest of the countries in which you have actually twin peaks, you have typically central bank is also the prudential supervisor. So you are basically seeking to exploit those synergies between monetary policy and financial stability. So you basically concentrate on that, and therefore you, by doing this, of course, you have to break basically this combination of consumer protection and overseeing solvency for insurance companies. So you have to basically to choose one more or another based on what type of synergy you think is more important.
Yeah, that's for sure true that the first concern of central banks is not about conduct of business. That's definitely the case. Katie, let's try to capture another element. It was mentioned, of course, as part of the challenges at the beginning in terms of innovation and new types of course, of new technologies used. One of the quite, I would say, important works that you have in Canonic, for example, is, of course, to look at the complaints from the consumers on an ongoing basis. Have you started to see already complaints coming with innovative products, new distribution channels, new technologies being applied?
So in Connecticut, we have an InsurTech hub and we have an accelerator. And so we have, a great deal going on. And what we found is, our job first and foremost is consumer protection. So, and we have to balance the need between the desire to innovate and that consumer protection element. And so what we've been doing is encouraging companies, incumbents, as well as the InsurTechs, to come in and talk to us early in the process when they still have plans on the drawing board or things are in development, so we can understand what they're trying to achieve. We can raise the concerns we may have from a regulatory perspective and see how we can work through those issues. And we've also found it very valuable to go and talk with, we have the advantage it's right across the street from our office, so we go over and answer questions of the insurtechs so that they understand how insurance regulation works, because it's, for lots of these folks, this is really foreign, and so
Language, yes.
it's not uncomplicated, but we work through those issues, and we found that to be incredibly valuable as we go through the process. And so we're not seeing right now, these huge consumer issues, but one of the things we're making sure as products are coming to market, consumers really understand what they're getting themselves involved in, that it's clear. And innovation offers the opportunity to have much more simple, easier to use products, and we think that's a huge opportunity. But we're not seeing major trends to point to, but that doesn't mean they won't develop and that we'll be looking for it.
Yeah. Very good. Kasiang, one of the, I'd say, really important issues that have been flagged also during the discussions, and it touches, of course, with conduct of business, it's the usage of data. And of course, one of the big challenges is where are the barriers and what are the ethical elements that you should, as an insurance company, define also for yourself in terms of where's the barrier of using that data from an ethical perspective. Is this something that you've been working on also? Do you think that this is important going forward for the acceptance also from consumers of more usage of personal data?
I think it's still early days for us. I can share a bit examples there as well. But I think typically, if you look at, like, for example, Singapore and a lot of countries as well, there's regulations on personal data protection. So in terms of how do you collect the data, how do you use the data, what can you use for, you need consent for this stuff, how long can you store it for, and what sort of data you need to get rid of after a while, right? So I think there are elements of regulations in safeguarding the consumers or the personal data of consumers, and I think that's a good start. And from insurance company perspective, that is becoming kind of a new regulation for us, because it doesn't sit with the insurance regulation. It sits kind of separate, right? So for us, like in Singapore, for example, when we run our business, quite clearly, the aspect of handling personal data become more and more important. And we need to spend quite a bit of investment to make sure that the data are well managed, right? So I think that's one area of it. The other one is that how are we going to use the data? So I think more and more, of course, you can say the fintech company are trying to come up with new innovation, but established insurance company are also starting to use data, including getting other set of data to complement what they have in order to help them. You can say that is big data to help them to kind of predict and provide a more engaging solution for the customers. But when we are using that data, we are very mindful of these regulations on how do we use it. And we are also mindful in terms of, are we discriminating against the customers, right? So I think that is one area that I would say is a gray area that we need to actually think through, and we need to build that into the product development process.
Very good.
What we have done so far, for example, for Manulife in Singapore, is we definitely have actually go back to the customers using some of these additional data that we collect from the customers, and also using some predictive techniques to offer, I wouldn't say a cheaper product, but to offer a more convenient way for them to take the product. For example, instead of saying you need to fill out all the questions, we say, we can offer this insurance to you without underwriting, right? So that actually is a convenient, hopefully they would have a higher propensity to take up insurance. But I would say this is early days right now for us. And the evolution of this would require quite a lot of thinking.
Of course. Greg, how worried are you of the usage of these new technologies, big data, in terms of the consumer protection, and especially in terms, of course, of the selling practices?
Well, quite, yeah. I would say.
I would imagine.
That doesn't surprise you. If I would be an insurer, I think there are many interesting ways to use data. Let me let me get into the head of an insurer now. I could select the most low-risk and most profitable consumers. For instance, consumers who are willing to give their sporting data. They're probably much more healthier, hence less claims. So that sounds very profitable. I could also optimize renewals, for instance. Consumers who I see that they're surfing around at other price comparison websites, well, they I think I have to offer a better deal than the non-active consumer who is just paying, well, every year and it's not really very, he has a nice income. I can also see that from other data. So yeah, we can just increase his premium gradually. He won't notice and he won't care, because people in generally don't care too much about, in despite the fact that they're paying 1 month of their income, yearly income on insurance, people don't really look at it profoundly. So that's it. And then a third thing, that's a bit more scary one, is to optimize claim settlements.
Yes. Yeah.
And there's, for instance, a voice recognition software that can detect whether a client, if he's calling to make a claim, how confident he is, or is he maybe a little bit uncertain about how bad the damage is, and then he could use maybe that voice recognition software to make a better claim settlement offer or not. So those are possible things that you can do, and also, and that's a bit of a contradiction, to keep a connection with the consumer, because in the end, the world is getting much safer. Look at car insurance, automated cars. Will we need? Well, traditional car insurance will fade away in the longer term, probably. But through data, well, I can still, as an insurer, keep that connection with my client, and maybe offer other services which are not really maybe core insurance business. But that's the insurer. So let me turn it around. What risks does that create? Well, there's the exclusion risk, obviously, for people with a high risk profile, the end of risk pooling. So we could have a whole session on that. There's a cost of privacy. Will I have to pay more if I'm not willing to disclose my whereabouts, my what I'm eating, for instance? There's the price optimization. And there is interesting. I know that in some federal states that insurers cannot use for the pricing. They can't use non-risk-based parameters anymore. So I think that's a very interesting evolution. And then there's a whole the big brother debate. Do we really want to? There's the danger of some kind of surveillance capitalism, that you're constantly tracked by your insurer. There's maybe, to give a last example, is the famous toothbrush, where you get a premium if you brush your teeth very good, and this is being tracked by a toothbrush which is given to you freely, and it tracks through Bluetooth whether you really brush your teeth very well. So then you're looking into the mirror and then thinking about your insurer. Is that the scenario we want to have in 5 to 10 years? Well, just to say that we believe that we need a broad societal debate on the limits on the boundaries in terms of privacy and in terms of fairness, and we could, for instance, look as supervisors what kind of data requires more explicit approval from consumers or greater transparency, and what kind of data should not be collected at all for pricing, marketing, or whatever, by insurers for ethical or privacy reasons.
Great.
So,
There's a.
I'll stop here for my wish list.
Yes. You know, the more you talk, the more you unnerve the audience. So it's
my
better
apologies.
that we stop. No, but I think that those are very fair points, and I think what is really important, and I'm sure that that's what is occurring and will continue definitely to occur even more in the coming years, is this dialogue that needs to exist in order to have a good understanding of where those kind of ethical elements the society as a whole is prepared to accept. And I think that's very important for the trust of consumers in innovation and in the insurance sector. And I think that we should all be part of that dialogue and be positive about that. Fernando, looking at the other side, I've noticed that the FSI published some reports about the use by supervisors of technology, you know, this kind of jargon of RegTech and SupTech. how do you see that evolving? How important you believe that can be for better supervision also?
Yeah, no, absolutely. I think the potential is huge. In this analysis that we published, again, I think it was in June, July, we talked to early users of new technologies for supervisory processes. We found that a number of supervisors are using techniques in two different domains. One is data collection, the other one is data analytics. For data collection techniques, they use it actually for reporting, for data management. For data analytics, actually used in several areas, certainly conduct of business, market integrity, but also micro brew type of investigation, type of analysis. So I think that overall the experience is certainly positive. It has clear benefits in terms of effectiveness. Actually, you have access to data in a much more flexible and useful way. Certainly, actually, the potential is basically to replace fully at some point the standard template-based supervisory reporting as a basis for supervisory action. Also in terms of efficiency, because those are automated mechanisms, of course, could make supervisors to save a number of FTEs. That's very clear, so can increase efficiency. But more important than that, actually, the capabilities of your supervisory action can be increased markedly. It's not about using better and faster the data you already have. It's that you can use much more data. Yeah. You can combine different data sets with a structure and structure in a way that could actually help the supervisory process in a market way. Of course, we were also interested in knowing about the challenges and the difficulties. Not everything, obviously, is wonderful. There are a number of limitations. We have to do with computational capabilities. We have to do with cyber risk, obviously. We have to do actually with hiding the difficulties to hire and to keep the right talent. Sometimes there are important difficulties and internal organizational arrangements that are not particularly friendly for an orderly assimilation of the new technologies. So there are important challenges there. And also it's important to take into account that, well, I mean, machines are not always right. So it's clear that you may get actually wrong signals in the form of false positives or false negatives that may actually damage your effectiveness, the effectiveness of your supervisory process, and may actually generate as well important reputational risks. So that's why we stress in the document the importance of putting in place a robust strategy within the supervisory organization in order to properly address all those limitations. And it's important to be absolutely open to the introduction of new technologies in your supervisory processes because the potential is huge, but at the same time, of course, you have to do it in an orderly way in the framework of a well-defined strategy.
No, that's definitely an area where supervisors are behind the curve, that's for sure. But we need to catch up, and I think there's a lot of promise in terms of more efficiency and better usage of the data that is available. So I think we still have some minutes to have one or two questions. Maybe I can please ask to put the second question on the board. The question was, looking at consumer protection in the future, what could be the main threats in the coming years? Wow, the unethical use of data. I think Greg won. 35.7, and then cyber, yes. Exactly, it was also mentioned. So interestingly, all of the main answers quite related to issues on new technologies, which I think it's an important takeaway also from the audience. So please, who has one or two burning questions? And of course, Bernie has a burning question. Please, Bernie.
Thank you. I'm Bernie Birnbaum with the Center for Economic Justice, a consumer organization. So Greg and Emma and others have spoken eloquently about the potential with big data algorithms for unfair discrimination, relying on biased data or biased modeling. But I wanted to draw your attention to the prudential financial impacts of poor modeling. If, for example, you rely on a modeling effort as opposed to traditional actuarial methods, that rely on, say, the last 10 years since the financial crisis, you may predict a certain outcome with your telematics program that is going to be completely different when the economic cycle changes. So the importance of looking at these new algorithms is not only critically important from a consumer protection standpoint, but I'd suggest also from a prudential standpoint to make sure that the models don't use biased data and that the models don't have unreasonable assumptions, because we've seen with the long-term care crisis in the US where poor modeling of long-term care rates has not only created problems for consumers and companies, but for the entire industry, and it's spreading.
Yeah, it can be a systemic element. Thanks, Bernie. Gabor, please.
My name is Gabor Hanak, and I'm representing the International Actuary Association. And following up on this issue.
So the guys that do the models.
Yeah, models. So you might think that actuaries are on the prudential side, which is true. But we are very much concerned about conduct. And the IAA, my organization, developed model standards, a number of model standards. And one of them is dealing with the governance of models.
Yes.
So how actuaries should apply models, how use models, how select or how develop, how to change models. And we have a model standard on exactly that. And I believe that it's a big achievement, although our model standards, the IAA model standards, are not applicable directly to the individual actuary. It is applicable only if a member association of my IAA association adopts those standards. But then it is applicable, and it can be compulsory for actuaries to apply. And this standard, we have a general standard on general actuarial practice, and we have a standard on governance of model. That's my contribution. My question, do you think that similar conduct standards would be useful for other professionals or other experts that work for insurance companies? Thank you.
Who wants to answer this? Importance of professional standards for other types of professions. Katie, please.
So, I think there are professional standards for underwriters and financial analysts, CPAs and others that work at insurance companies and work at insurance departments. So I think that's been a long tradition. I think it's an important part of making sure that you have qualified professionals and they're being held to standards. So we would totally agree with that.
Very good. One last question to finalize. Yeah, please.
Thank you. I
Go
promise
ahead.
I'll be quick. I'm Paul Walsh. I'm a journalist for Insurance Era magazine.
Yeah.
We've already briefly mentioned the impact of robotics. And just to address that kind of head on once more, how can supervisors deal with the growth of robotics and also things like self-learning algorithms? How can supervisors deal with that?
Emma, that's a good question for you.
Yeah, that's a really tricky question, I think, because it's hard to look into the algorithm and understand it if you're not an expert, a data analysis expert. So I think my preliminary response to that would be to look at the governance around it and to make sure that the insurer or the firm that is using the algorithm can have certainty that it has been properly developed and it's reliable and that it's future-proof and that it's not producing outcomes which are not fair or unreliable or unsustainable. So I think that in the first instance, we'd look at those governance processes around the development and origination and testing of the algorithm on a regular basis.
Very good. Thank you. My fellow Gabriel is telling me that I need to finalize, so let me just thank you very much for this panel, very great contributions. And there's only one thing that I think we can take from this is that definitely, be it prudential or conduct of business, supervision will be quite exciting in the coming years. So if you're not thinking about that, join the supervisory side. We're going to have a very nice job. Thank you very much, and a round of applause.
Thank you very much, Gabriel. Still love your name so much. So it was the last panel of this 25th annual conference. It was a pleasure for me to guide you during those 2 last days. As a promise, I started my speech saying that all the panel's presentation and video will be online on the site of the IAIS. The one of yesterday's panel are already online on the Events Annual Conference 2018. You all know how to say moyen, so I will learn you how to say goodbye in Luxembourgish, but just after that, I'm going to give the word to Jonathan for the conclusion and Rob. So to say bye, you just say Eddie. So Eddie, and thank you.
So excellent. Thank you very much. And I know time is getting late, but just a few brief wrap-up comments as this brings us to the end of our 25th annual conference. We set out to provide you, our members and our stakeholders, with an update on progress on delivering our part of the post-crisis reform agenda, and a sense of the issues that we're grappling with as we look to our future agenda. I hope the message was clear. First of all, that we remain very much on track with